Hello everyone, welcome to Just Invest Today. And in today's video, we are talking about the S&P 500 and why you can't beat the S&P 500 if you're not looking at it in the bird's eye view. Because man, how hard is it to beat the S&P 500 moving forward? Because when you think about it, you have to look at your portfolio and the stocks that you own, and you got to compare it to the best stocks in the S&P 500. The top 5-10 stocks in the S&P 500 is providing so much weighting to what the market has been doing. 20% of the weighting is in the top holdings of the S&P 500. So when you look at it at that bird's eye view, you have to look at the stocks that you own and see if you can beat these companies. Can you beat Apple, Microsoft, Tesla, Nvidia, Berkshire, Amazon with the companies that you own right now in the next 5 to 10 years? Because right now the S&P in the last 5 years has been doing 14%, 15%. I'm not saying the S&P 500 is going to be doing that moving forward because that's a high bar. The S&P over time has been averaging around 8 to 10%. So I'm not saying you're going to be averaging 14 to 15% moving forward. But you do have to compare your companies to these damn stocks in the S&P 500. Do your companies have higher gross margins, operating income, revenue, return on equity, return on invested capital? Because that's what you're going to have to beat in the next 5 to 10 years. These companies like Amazon, Tesla, Nvidia, Berkshire, that's what you have to compare yourself to. Imagine you investing your money and you're averaging 14 to 15% a year. That would put you in the top tier investment sphere. You would be a top guru if you could average 15 to 14% over a 20, 30, 40 year time span. That would be mind blowing. And it's always good to compare your best stocks to the S&P 500 to see if you really have companies in your portfolio that you truly believe can beat out these companies, man. If you don't have these companies or you don't really believe in these companies that can average these returns, and if you bought them at a good valuation that they can beat these companies moving forward, then you have to really reevaluate your companies that you own, man. So in this video, we're going to talk about it. But before we do, can you like this video, subscribe to my channel? I'm always providing you guys with so much new content, man. So like it and subscribe. Guys, I want you to be honest with me about this. Tell me down below, what companies do you honestly think can beat out all of these companies? And if you have companies that are going to beat the S&P 500, because if you're not going to beat the S&P 500 over time, over 5 to 10 years, why even invest in individual stocks at this point? Look at the companies that we have to beat. Apple, Microsoft, Amazon, Tesla, Google, Nvidia, Berkshire. And look at the weighting, 7%, 6%, 3%, 2%. The top weighting of these stocks have never seen this before. Like, you've never seen anything like this before. The top weighted Apple stock is 7%. So we have these top stocks taking up 20% of the S&P 500 easily. Apple's 7.1% weight in the S&P 500 today is the largest weighting we've seen for an individual company going back to 1980. And that's the power of Apple. The S&P 500 over 5 years, 91%. You have gotten around to 14-15% in 5 years. Guys, that's amazing. How many people can say they can return 14-15% over 5 years? I'm not saying that's going to be going out forward, but man, Apple, Tesla, Amazon, Microsoft, are we saying these companies can't do that in the next 5 to 10 years? What is really going to stop them? So let's go to Apple. We have to find companies, look at this, 1 year, 41% return. Damn, that's just damn. Think about the companies you own. Are they generating revenue like Apple, 15%, negative 2%, 5%, 33%? Balance sheets like Apple, over 63 billion in cash? Like, that is incredible, and they're seeing sustainable growth with their moat. Do you have a company that has a stronger moat than Apple in your portfolio? Do they have a better ecosystem? Are they growing its customer base like Apple? Think about those questions. Now we can even go to Tesla. 5 years. Look where Tesla was in 2017. $60. Over 1,600 damn percent made. In 5 years, you would have had a 79% compounded annual growth rate. We know what Tesla stands for. We know what Tesla's been doing. They've been growing revenue like crazy, 82%, 40%, 28%, 70%. They have a crazy brand moat. A crazy brand moat with a crazy manager, genius at the helm, CEO, that's going to drive the product moving forward. They have a lot of new things in the pipeline. I'm not saying Tesla is this amazing investment right now, but do you have companies that are going to beat this kind of expanding market in this electric field for cars? Like, do you have an ecosystem? Do you have a brand that's better than Tesla, that has a better CEO? You got to think about these questions when you're thinking about buying into these companies, because now we're moving on to Amazon. Over 5 years, $894 moved to $3,169, 254% over time. Look what Amazon has done. And we want to, honestly, when we really go down into it, we want to get companies that are providing better gross margins, better operating income. They might even have better stories than what these companies are providing, that you can see the addressable market growing way better than the Amazon, than a Tesla, than an Apple. Like, what companies are you seeing that can really do this and beat out these companies? Because Amazon has 42% gross margins, and they're generating $469 billion of revenue. What companies can you honestly say that can do that with an amazing balance sheet, with cash on hand, generating cash flow, and they're actually growing their market in advertisement, in cloud computing, in just warehouses, satellites? Guys, you really have to think about these questions when we're getting into new businesses, because we have to compare all our businesses to these new ones. Microsoft. And remember, these are providing the S&P 500 with all of these returns. You are going to have to find companies better than these companies by either finding companies that can generate more revenue, better profit, or you're just buying these companies at amazing valuations that can provide these long-term returns over time. Either one, because over 5 to 10 years, if you're going to hold these companies, you're not going to do much better than the revenue, that the earnings that they're going to generate. So we have to find companies that are going to earn, that are going to generate, that have a bigger addressable market than these companies. And do we really have that? Microsoft, cloud computing, their cloud services is growing crazy. They just are going to acquire freaking Activision. You know how software is so important to Microsoft and what they're doing in the software field? Guys, 14%, 13%, 70% revenue growth. And on top of that, we have to look at their moat and how strong their moat, their ecosystem, their products. You can't overlook that with 68% gross damn margins, with 42% operating margins, with a balance sheet indestructible, paying a dividend, $125 billion in cash. So, man, we have a high bar to beat. So, when we really think about it, you have to honestly answer this question to yourself. If you have companies that you can see over time beating out these companies in 5 to 10 years. If not, you have to think about investing in the S&P 500 going forward if you don't think these companies are overvalued. And that's what it all comes down to, man. So guys, tell me what you think. Leave a comment down below, like this video, subscribe to my channel, and I'll get back to you in the next video. Peace!